Hello, everyone. Let me ask you something. When you look at a price chart, what do you really see? Most traders see candles moving up and down, patterns forming, lines being respected or broken. But they miss the most important piece of information on the entire chart: volume. Price is only the advertisement. Volume is the actual transaction. Judging the market by price alone is like judging a restaurant by its signboard without ever checking whether there are customers inside. In this lesson, you are going to learn how to read volume properly, not just what it is, but what it means, why it matters, and how it reveals what is truly happening behind every move. After this, every candle will tell you a story, and volume will be the proof behind it. This is not financial advice, only education. The market speaks two languages at the same time. Price tells you what happened, up, down, or sideways. That is the headline. Volume tells you how much conviction stood behind that move, how much participation, how much real money was committed. Think of it like an election. Price is who won. Volume is how many people voted. A result with 10 voters means very little. A result with 10 million voters carries authority. The same principle applies in speculation. A large green candle on low volume should make you suspicious. A large green candle on high volume represents conviction. From now on, do not only ask where price went, ask how much force was behind it. To understand volume, you only need one mental model: effort versus result. In the market, volume is effort, the energy and capital being used. The candle is the result, how far price actually moved. Imagine pressing the gas pedal of a car. The pressure on the pedal is effort. The distance the car travels is the result. When effort and result align, strong volume and wide price spread, the move is healthy and genuine. When effort is large but result is small, something is wrong. If the engine roars but the car barely moves, there is resistance. On a chart, that is a narrow candle with massive volume, absorption. Strong hands are taking the other side, quietly absorbing orders. Eventually, when buying pressure exhausts itself, price often reverses sharply. On the other hand, if price rises on low volume, it does not mean buyers are powerful. It means sellers are absent. The path is clear. The market does not need much effort to move when there is no opposition. High volume with a wide candle confirms strength. High volume with a narrow candle warns of absorption. Low volume with continued movement suggests lack of opposition. These principles form the foundation of intelligent tape reading. Now apply this thinking to recurring patterns. When price is falling aggressively and suddenly you see extreme volume but the candle closes well off the lows, that is stopping volume. Panic selling is being absorbed by stronger interests. High effort, limited downward result, a potential turning point. At market tops, you often see the opposite. A buying climax. Price rallies strongly, volume explodes to the highest level on the chart, and the public becomes euphoric. Yet that surge of buying allows larger operators to distribute their holdings into demand. It appears as strength, but it is often the final stage of a move. Then there is the no supply test. After an uptrend, price pulls back on very low volume. The market is probing for sellers and finding none. Low effort, minimal downside result, a sign the trend may continue. Understand this clearly. Volume bars do not show buying versus selling dominance. Every transaction has both a buyer and a seller. Volume measures activity, not direction. The color of the volume bar simply follows the candle's close. What matters is the size of the volume and where the candle closes within its range. That is how you judge who is winning the battle. One of the most powerful warnings appears when price and volume diverge. In a healthy advance, rising prices should be supported by rising or stable volume. If price continues to make new highs while volume diminishes, the move is losing fuel. Like a rocket burning through its reserves, the thrust weakens before the fall. The same applies in declines. Falling prices with shrinking volume indicate seller exhaustion. When participation dries up, the trend is vulnerable to reversal. To make this practical, follow a disciplined process. First, zoom out. Study the broader structure and overall volume behavior. Is participation expanding or contracting? Are there abnormal spikes? Second, examine key levels of support and resistance. When price approaches them, compare effort and result. A breakout on strong volume and wide spread confirms strength. A breakout on weak volume invites suspicion. Third, wait for confirmation. Do not act on a single bar. Observe how the market reacts after the event. A pullback on light volume after a breakout often confirms strength. Patience is not weakness, it is discipline. Before entering any trade, ask yourself, is volume increasing or decreasing relative to recent action? Does effort match result? Are there abnormal spikes near critical levels? Is price diverging from volume? What does the next bar confirm? These questions remove guesswork and replace it with observation. Volume is not just another indicator. It is the footprint of money. Price can be temporarily influenced, but sustained movement requires participation. Volume reveals commitment. When you learn to read it, you are no longer reacting emotionally. You are interpreting evidence. Study the interaction between effort and result. Observe where the crowd becomes active and where it becomes exhausted. That is how professionals think. The market leaves clues for those who know how to read them. Stay patient, stay disciplined, and let volume guide your judgment. Strong volume. Expansion supported by participation. That is harmony between effort and result. It tells you that demand is genuine, supply is being overcome, and the path is relatively clear. But suppose you press the gas hard, and the engine roars while the car barely moves. There is friction, resistance, something pushing back. On a chart, that is heavy volume with a narrow spread. Effort is high, result is limited. That imbalance reveals hidden opposition. Strong hands may be absorbing supply or distributing into demand. When effort increases but progress stalls, you must ask who is on the other side of the trade. This is how professionals interpret the tape. They are not impressed by large candles alone. They study the relationship between participation and progress. If price rises easily on expanding volume, they recognize accumulation or aggressive buying. If price struggles upward despite extreme volume, they suspect distribution. If price drifts higher on declining volume, they understand that the advance may lack sponsorship. Markets do not turn because of price alone. They turn because participation shifts. Consider the psychology behind it. When a market begins to rise from a base, volume often increases steadily. Early buyers step in quietly. As confidence grows, more participants join. The public becomes aware only after the move is well underway. By the time enthusiasm peaks, volume frequently surges to extremes. That surge often marks transition. Strong hands distributing to late entrants. The inexperienced trader sees strength. The professional sees opportunity to reduce exposure. Volume at extremes tells you when emotion has reached its height. The same pattern unfolds at bottoms. During a prolonged decline, volume may expand as fear intensifies. Panic selling climaxes with heavy turnover. Then suddenly, despite continued effort, price refuses to fall much further. The spread narrows, closes improve, and selling pressure is absorbed. That is not weakness. That is strength quietly entering. Once the weak hands are exhausted, price can rise rapidly because little supply remains. The reversal was not caused by a magical indicator. It was revealed by the imbalance between effort and result. You must also study contraction. Healthy trends breathe. After an advance pullback should occur on lighter volume. That tells you that opposition is limited. The market is testing lower levels and finding little interest to sell. When volume contracts during corrections and expands during advances, the trend is internally strong. The opposite warns of vulnerability. If rallies occur on shrinking volume while declines expand with activity, distribution may be taking place. The market may appear stable, but the internal character has changed. Another subtle clue lies in the close of the bar. Wide spreads with strong closes near the high reflect control by buyers. Wide spreads with closes near the low reflect control by sellers. Narrow spreads with heavy volume reflect struggle. Neither side gaining decisive ground despite Fort professionals study these details because markets are auctions. Every bar is a negotiation between supply and demand. Volume reveals how intense that negotiation was. The close reveals who had the advantage at the end. Time also plays a role. Breakouts that occur after long periods of quiet consolidation often carry significance, especially when volume expands sharply. The market has built cause, and now effect appears. Conversely, breakouts that occur late in extended trends without fresh participation often fail. The crowd chases what is already mature. Volume exposes whether new interest is entering or whether activity is simply being transferred from one group to another. Patience is essential. Volume signals rarely stand alone. They must be read within context. Trend, structure, location. A high volume bar in the middle of a range may mean little. The same bar at a major resistance level may signal distribution. Always ask where the activity is occurring. Markets behave differently at extremes than they do in equilibrium. At the edges of ranges, effort versus result becomes particularly informative because strong interests defend or challenge those levels. Risk management must align with this understanding. When volume confirms your position, confidence may increase, but discipline must remain. When volume contradicts your expectation, humility is required. If you are long and see repeated high-volume up bars failing to extend progress, pay attention. The market may be telling you that demand is being absorbed. If you are short and declines begin to occur on contracting volume, be cautious. Selling pressure may be drying up. There is also the principle of progression. Healthy trends show expanding volume in the direction of the move and contracting volume, against it. If you observe the opposite, expanding volume against the trend and diminishing volume with it, the internal structure is weakening. The surface may still appear intact, but beneath it, sponsorship is fading. Eventually, price will reflect that shift. Volume is sometimes called the fuel of the market. Without fuel, trends cannot sustain themselves, but fuel can also exhaustion. Extreme volume often appears at turning points because emotion reaches its peak. Fear and greed drive participation to its highest levels just as trends mature. Recognizing this dynamic allows you to avoid chasing strength at the wrong time and to recognize opportunity when others panic. Consistency in observation builds skill. Study charts daily, compare rallies with their volume, compare declines, note how markets behave after extreme spikes. Over time, patterns emerge. You will begin to sense when a move is healthy and when it is forced. This is not intuition in the mystical sense. It is pattern recognition built through disciplined study of effort versus result. Remember that volume does not predict the future with certainty. It reveals probability. It shows whether professional interests are likely active. Your task is not to forecast perfectly, but to align yourself with the side showing commitment. When effort and result align, probabilities improve. When they diverge, caution increases. Markets are driven by human behavior, optimism, fear, confidence, doubt. Volume measures the intensity of those emotions expressed through transactions. Price is the visible outcome. Volume is the underlying energy. When you combine both, you move from guessing to interpreting. You stop reacting to headlines and start observing structure. Ultimately, mastery comes from discipline. Wait focus, high alignment between structure, trend, and volume. Avoid acting on impulse. Let the market demonstrate its intention through participation. Strong moves, supported by strong volume, deserve respect. Weak moves, lacking sponsorship, deserve skepticism. In this way, volume becomes not just a tool, but a framework for thinking. Study the relationship between effort and result relentlessly. Observe how markets behave at highs, lows, and transitions. Notice when participation expands and when it contracts. Over time, you will begin to read the character of the market rather than merely its direction. That shift in perspective is what separates the amateur from the professional. Stay patient, stay objective, and let the evidence guide you. As you deepen your understanding, you will begin to recognize that volume is not merely confirming what price has already done. It is often preparing you for what price is about to do. The majority of traders wait for obvious moves. Professionals anticipate them by studying participation. Before a major move unfolds, there is usually a subtle shift in behavior. Volume begins to change character. The market may still appear quiet on the surface, but underneath, accumulation or distribution may already be taking place. Accumulation rarely announces itself loudly. It often occurs in sideways ranges where price fluctuates within boundaries. To the untrained eye, nothing is happening. But if you observe carefully, you may notice higher volume on up bars and lighter volume on down bars. You may see selling attempts met with strong closes off the lows. These are footprints. Strong interest accumulate inventory patiently, allowing weak holders to exit without pushing price dramatically higher. Once supply is absorbed, the path upward becomes easier. The breakout that follows seems sudden, but the preparation was visible through volume. Distribution operates in a similar but opposite manner. Near market highs, price may continue to grind upward, but volume behavior shifts. Rallies may require increasing effort for diminishing progress. You may observe repeated high-volume up bars that fail to extend meaningfully. Down bars may begin to show expanding participation. This tells you that stronger interests are transferring positions to late buyers. By the time the breakdown becomes obvious, the internal damage has already been done. Another important concept is testing. Markets constantly test supply and demand. After a sharp rally, a brief pullback on very low volume can serve as a test. The market is probing to see if sellers are eager to participate. If volume contracts and price stabilizes, the test is successful. Demand remains in control. Conversely, after a sharp decline, a small rally on low volume may test demand. If buyers fail to show interest, weakness persists. These subtle tests provide early insight into the health of a move. Climactic action deserves special attention. Climaxes occur when emotion reaches an extreme. In bullish markets, buying climaxes appear as explosive up bars with extraordinary volume. The public feels urgency. Fear of missing out dominates rational judgment. But this emotional intensity often marks transition. When everyone who wants to buy has already bought, there are few participants left to continue pushing price higher. The imbalance corrects itself. In bearish markets, selling climaxes appear as panic-driven declines with overwhelming volume. Fear reaches its peak. Once the selling pressure exhausts itself, even modest buying can lift price quickly because supply has been depleted. You should also observe how volume behaves during consolidations. Healthy consolidations show declining volume as volatility contracts. This reflects equilibrium. The market is resting, digesting prior movement. When volume dries up near the end of consolidation, it suggests that most participants are waiting. The eventual expansion in volume signals resolution. If the breakout is accompanied by decisive spread in strong closes, it indicates commitment. If the breakout occurs on weak volume, caution is warranted. Trend maturity can also be evaluated through volume rhythm. Early in a trend, volume tends to expand in bursts as new participants enter. Mid-trend, volume may stabilize while price advances steadily. Late in a trend, volatility often increases along with erratic volume spikes. The structure becomes unstable. Pullbacks deepen, recoveries weaken, and effort versus result begins to diverge more frequently. Recognizing these phases allows you to adjust expectations and manage risk appropriately. Volume analysis is especially powerful when combined with structural levels. Support and resistance are not merely lines. They represent areas where transactions previously concentrated. When price revisits these areas, pay close attention to participation. If support is tested on low volume and price holds firm, selling interest is limited. If resistance is tested repeatedly with increasing volume but limited progress, supply may be absorbing demand. Eventually, one side prevails. Volume often hints at which side that will be. You must also remain aware of the broader environment. News events, earnings reports, and macroeconomic data can temporarily distort volume. Sudden spikes may reflect short-term reaction rather than structural change. Context separates meaningful signals from noise. Study how volume behaves before and after such events. Often the most informative action occurs once initial emotion fades and the market reveals its true intention. Developing skill with volume requires repetition and review. After each trading session, examine key bars. Ask yourself what the effort was and what the result was. Did the move follow through? Did heavy volume mark continuation or reversal? Over time, you will internalize these relationships. Patterns that once seemed random will begin to make sense. Emotional discipline is inseparable from volume analysis. When you see strong volume confirming your position, avoid overconfidence. When you see warning signs, avoid denial. The market does not care about personal bias. It responds to supply and demand. Volume is the language through which that balance communicates. Remember that no single bar defines the entire narrative. Markets unfold as sequences. A single high-volume bar may be important, but its meaning depends on what came before and what follows. Always interpret volume within a sequence of behavior. Continuity matters. Confirmation matters. There will be times when signals conflict, volume may expand while price stalls temporarily before resuming trend. In such cases, patience is critical. Avoid forcing interpretation. Wait for clarity. Let additional bars provide confirmation. The goal is not constant action, it is informed action. Over the long term, traders who respect volume tend to avoid common traps. They are less likely to chase late breakouts, less likely to panic at bottoms, and more likely to align with genuine strength. They understand that markets move not because of opinion, but because of participation. When participation shifts, trends shift. As you continue practicing, focus on quality rather than quantity. You do not need to trade every fluctuation. Instead, wait for moments when effort and result align clearly. Wait for instances where volume confirms structure and trend simultaneously. Wait for instances where volume confirms structure and trend simultaneously. These are higher probability situations. In time, you will begin to sense the market's character. Some days are driven by conviction, others by hesitation. Volume reveals this mood. On strong days, participation expands steadily and follow-through is evident. On weak days, volume contracts and moves lack continuation. Adjust your aggression accordingly. Ultimately, mastery of volume analysis refines your perception. You move from reacting emotionally to responding analytically. You begin to see the invisible forces behind visible movement. That awareness builds confidence grounded in evidence rather than hope. The market constantly offers information, but only disciplined observers recognize it. Effort versus result remains your guiding principle. When effort produces meaningful result, strength is present. When effort fails to generate progress, imbalance exists. Study these imbalances, respect them. Stay patient, remain alert during extremes. Let volume confirm your thesis before committing capital. Over time, this structured approach will shape your thinking. You will no longer be guessing direction. You will be interpreting behavior. In the end, trading is not about predicting perfectly. It is about aligning with probability while controlling risk. Volume enhances that alignment. It reveals commitment, exposes weakness, and highlights transition. By studying it consistently and objectively, you sharpen your edge. Keep observing, keep questioning, keep comparing effort and result. With discipline and repetition, the language of volume becomes clear. And once you understand that language, the market's movements become less mysterious and far more logical.